afternoon and welcome everyone. Thank you for joining us for today's webinar. My name is Amy. I am the branch manager at Premia TNC Singapore Private Limited and so delightful to be here with you. Today, I would like to focus on some of the topics related to Singapore corporate tax reliefs and allowances which will help the companies to reduce their corporate tax payable. Just a little reminder, before we get started, if you have any questions during the presentation, please type them into the questions box on the right column. My assistant will collate and bring them to me. Submit them now and I will answer them later during the Q&A sessions. If any chance we omit your question, we will reply you via email after the webinar. Now, without further delay, let's start our webinar. Tax reliefs that helps reduce the tax bills. There are some reliefs for companies to help reduce their tax, which are group relief, loss carryback relief, and foreign tax credit. Group relief enables companies to deduct unutilized capital allowances, trade losses, donations of one company from the assessable income of another company in the same group. The qualifying conditions are the transferor and claimant of the loss items have to be Singapore Incorporated Company, belongs to the same groups of companies and maintain 75% shareholding threshold and have the same financial year end. As for the qualifying loss items, they are to be transferred, claimed in the following order: current year unutilized capital allowances, current year unutilized trade losses, and current year unutilized donations. Please note that income subject to tax at the higher rate will be transferred first, followed by the amount subject to tax at a lower rate, subject to the adjustment specified under Section 37B of Income Tax Acts if applicable. Next, loss carryback relief. The loss carryback relief allows 1 year carryback of current year unutilized capital allowances and trade losses and complement the existing policies of the company being able to carry forward their unutilized capital allowances and trade losses to set off future income or transfer unutilized capital allowances and trade losses to related companies. For year of assessments 2020, businesses may elect to carry back unutilized capital allowances and trade losses from YA 2020 up to 3 YAs immediately preceding YA 2020, that is, YA 2017, 2018, and 2019. Businesses may elect for the current and enhanced carryback relief based on an estimate of the current year unutilized capital allowances and trade losses for YA 2020. For year of assessment 2021, businesses may elect to carry back unutilized capital allowances and trade losses from YA 2021 up to 3 YAs immediately preceding YA 2021. YA, that is YA 2018, 2019, and 2020. Businesses may elect for the current or enhanced carryback relief based on an estimate of the current year unutilized capital allowances and trade losses for YA 2021. The last relief, foreign tax credit. Companies may claim foreign tax credit for tax paid in the foreign jurisdictions against the Singapore tax payable on the same income. There are different types of features and let's go through them one by one as follows. Types of foreign tax credit. There are two ways that Singapore companies may avoid double taxations. Firstly, double tax relief. A DTR is the relief provided for under an avoidance of double taxations agreement to reduce double taxations in the form of a tax credit. It allows the Singapore tax resident to claim a credit for the amount of the tax paid in the foreign jurisdiction against the Singapore tax that is payable on the same income. A DTR will be granted if the foreign tax was paid in accordance with the DTA provisions and is capped at the lowest of the foreign tax paid and the Singapore tax that would have been payable on the same income. Please note, a company is a tax resident of Singapore if the control and management of its business is exercised in Singapore. Secondly, unilateral tax credit. Effective year of assessment 2009, a UTC will be granted on all foreign source income received in Singapore by Singapore tax residents from jurisdictions that do not have DTAs with Singapore. Conditions for claiming FTC. The company must meet all of the following conditions in order to claim FTC. The company is a tax resident in Singapore for the relevant basis year. Tax have been paid or is payable on the same income in the foreign jurisdiction, and the income is subject to taxation in Singapore. Company in loss position. No FTC will be given to a company in a loss position. Companies with permanent establishments overseas. When a company have a permanent establishment overseas and the income is derived through that PE, the income will generally be taxed overseas. A FTC would be granted only if the income is also taxed in Singapore. Companies deriving passive income. Passive income, example, interest, dividend, derived from outside Singapore, will generally be taxed overseas in the year of receipt. Such income will be taxed in Singapore in the year of remittance. A FTC will be given when the income is taxed in Singapore. Now, let's move on to our next topic. Allowances. There are different types of allowances given by Inland Revenue Authorities of Singapore. There are Land Intensifications Allowance. Companies that qualify for LIA can claim qualifying capital expenditures incurred on the constructions of a qualifying building or structure. Writing down allowances for intellectual property rights. To enhance Singapore's attractiveness as a location for businesses to hold and commercialize IPRs, writing down allowances are granted on capital expenditures incurred in acquiring IPRs under Sections 19B of the Income Tax Act. Mergers and acquisitions allowance. Companies that make a qualifying acquisitions of the ordinary shares of another company may enjoy an NAA allowance on the purchase consideration. Capital allowances. Deductions claimable for the wear and tear of qualifying fixed assets. They are generally granted in place of depreciation, which is not deductible. Let's go in depth on different aspects of the capital allowances which the company may take note when applying. Who can claim? Companies that carry on a trade or business may claim capital allowances or expenditure incurred on the provisions of plants and machinery for use in its trade or business. An expense is incurred when the legal liability to pay had arisen regardless of the date of actual payments of the money. Capital allowances will no longer be given on expenditures funded by capital grants from the governments or statutory board that are approved on or after 1st of January 2021. This change seeks to eliminate double incentivizations where the capital grants are not taxed, while the expenditures funded by these grants are eligible for capital allowances. Plants and machinery generally refer to a fixed assets that have the following characteristic. The item is not a trading stock of your company, not for resale purposes. The item functions as an apparatus used for carrying out the business or trade activities of your company, and the item is not part of the setting or part of the premises in which your business is carried on. Those items that are part of the setting or part of the premises may be claimed as renovation or refurbishment instead under Section 14Q deductions. Claiming. To claim capital allowances, company must make the capital allowance claims in its corporate income tax return for the relevant years of assessment and prepare the supporting schedules in its tax computation. The tax computations must be filed with Form C. If the company is filing Form CS or Form CS Lite, retain the tax computation and submit it only upon IRA's request. Deferring capital allowance claim. There are circumstances where companies may wish to defer capital allowance claims. Typically, company defer capital allowance when the company is in a loss position or the company qualifies for the tax exemptions for new set-up companies. Selling, converting, or scrapping fixed assets. When a fixed asset is sold, converted to trading stock, or written off, you need to calculate balancing allowance or balancing charge if the capital allowance have been claimed for the assets previously. BA is tax deductible, whereas BC is taxable income. BA and BC are the difference between the sales proceed and the tax written down value of the assets disposed. Section 24, election. Transferring fixed assets to related companies. When a company takes over or buys fixed asset from a related company where there are 50% of more common shareholders, both companies may elect to transfer the assets under Section 24 of the Income Tax Act. The effect of electing for Section 24 is to disregard the sales except for the change in persons entitled to the allowances. In other words, the transactions will not be considered a sales, but a transfer of assets and its allowances. Methods of capital allowances calculation. There are few methods for calculating capital allowances. There are 100% write-off in 1 year, write-off over 2 years, write-off over 3 years, write-off over the prescribed working life of the assets. 100% write-off in 1 year, Sections 19A 2 and 19A 10A. Under Sections 19A, assets that qualify for 100% write-off are computers, prescribed automations equipment, and low-value assets. Some commonly claimed prescribed automations equipments are computer, laptop, printers, and computer software. Low-value assets. Company may choose to write off low-value assets in 1 year, provided certain conditions are met. A low-value asset is one that does not cost more than 5,000, and the total claim for 1 year write-off of all low-value assets must not exceed 30,000 per YA. If the amount exceeds 30,000, company can still claim capital allowances over 3 years, or 2 years for YA 2021 and YA 2022, or the prescribed working life for the low-value assets existing the cap for the YA. Write-off over 2 years, Section 19A 1E. Businesses are given an option to accelerate the write-off over 2 years instead of 3 years, or over the prescribed working life of the assets on the cost incurred in acquiring the assets during the basis period for YA 2021 and YA 2022. The rate of accelerated capital allowance are as follows. 75% of the cost incurred to be written off in the first year, and 25% of the cost incurred to be written off in the second year. No deferments of capital allowance claims is allowed under this option. Write-off over 3 years, Section 19A 1. company may choose to write off all assets that qualify for capital allowance over 3 years. Under the 3 years write-off, capital allowance is given in the form of annual allowance. Write-off over the prescribed working life of the asset, Section 19. Under this method, capital allowance is granted over an asset's prescribed working life based on the 6th schedule of the Income Tax Act. To simplify capital allowance claim under Section 19, the prescribed working life of assets in the 6th schedule will be streamlined to 6, 12, and 16 years. Our tax specialists will be based on companies' situations in determining the best options for capital allowance claiming to reduce the tax payable while staying compliant with the law. Now, I would like to go ahead and take some time for the question. You can just type in your questions on the right columns of your screen. Otherwise, please click on the live chat on the top columns in red and have a meeting appointment with us. Now, the first questions. My company received dividends from an Indian residence company which was net of India Dividends Distribution Tax, DDT. Does the DDT qualify for foreign tax credit? The answer is yes. The DDT will qualify for foreign tax credit in the form of an unilateral tax credit under Section 50A, Subsection 3 of the Income Tax Act. This is provided that the Singapore resident company owns not less than 25% of the total numbers of issued shares of the Indian company paying the dividends. Can my company claim 100% of the cost of equipment purchased for chemical hazard control or noise control in 1 year? Yes, your company may claim the full cost of such equipment as capital allowance in 1 year if the equipment is approved by Ministry of Manpower. Alright, we also have a question received from the live questions platform and I'm going to answer it. Let's see the questions. Must a company be in a profit position before it can submit an application for a waiver of the shareholdings tax? The answer is no. The applications for a waiver of the shareholding tax can be submitted when a substantial change in shareholders occurs. Well, I think we are heading to the end of today's webinar. I hope this webinar will benefit you. If you would like to find out more or looking to begin your business expansions and investments journey, please feel free to contact us for further discussion. Thanks again for joining us today. We'll see you next time. Goodbye.